Good evening, everybody. Good evening. My name is Daniel Young. I'm the owner and founder of Adapted Perspective and the Adapted Perspective social media platforms, and I am back with more strategy on using closed-end funds and improving our overall investments. So this is an unedited video. Who knows what you'll hear in the background as I film these in my house, and chances are you'll hear my cat because he's freaking out at the front window right now. But maybe he'll go to sleep because he just ate. Maybe. I am not a financial advisor. I am a financial strategist, just an all-around strategist. And I don't speak like the herd. I walk in limited company and sometimes I walk alone. And quite honestly, I like these raw videos because it's exceedingly honest. It's incredibly transparent. And I like that much better than just beautified videos. So these videos are still going to be shorter in comparison than my previous videos because I've put all that big picture strategy into separate videos. I'll do brief updates week to week, but it's not the deep dive into strategy and uh, overall market awareness that maybe like videos from about a month ago were. So from the past week, the short-term rates dropped and mortgage applications went up. So that's a no-brainer. Rates drop, mortgage applications go up. The bond market seems pretty nonplussed about an incoming presidency. That's very different than the corporate media hacks. Those guys are pumping fear and pumping anything they can in the hopes of just getting you down. Um, but honestly, the bond market's not buying it, and the shareholders agree. I mean, me as well. But people are running to bonds. I mean, they want bonds like government bonds and corporate bonds that pay. Why? Because the Fed isn't doing a great job of controlling inflation. You could argue that they're making it look like they're trying, but inflation's on the rise. So and it's not jumping 2% a week or 2% a month. It's not that, but it's subtle. So why would inflation rise? If they're cutting rates, why would inflation go up? That seems counterproductive. Well, I still think the Fed overall waited too long. So they're a little behind the curve. Two, they're quietly printing money. Now they're not printing trillions of dollars like they did during COVID. So it's not crazy obvious. But they're quietly printing money, which means they're still quietly manipulating the market. They talk about quantitative tightening, but they're really quantitative easing. And they're leading us into a recession. We're lowering rates. Maybe we get another quarter point cut, maybe not. They're lowering rates and at the same time printing more money so inflation goes up. That seems very counter narrative. So, worst case scenario, say say we never see the recession. Say it's a no landing or a super soft landing, right? No true recession. The economy keeps chugging along just enough to scrape us by. Worst case scenario, the Fed is intentionally putting the new group in a bad territory or as bad as possible because they doubt that Trump and company can turn things around, or they really don't want Trump and company to turn things around. They want people to distrust Trump and his people so they trust the Fed more. I think Trump and company can turn things around. I don't trust the Fed. I mean, they tell us inflation is this, they tell us overall CPI data is that, they tell us the overall rate is this. It's always worse than what they say. Right. I do know that Janet Yellen, the former Treasury Secretary, since she just left her post, sandbagged the incoming admin team over debt concerns. She could have refinanced a lot of our outstanding debt at lower interest rates, but never did. And so 4 years ago, when the overall rate was pretty darn low, I mean, pretty darn low, now it's not. I hope that freaking Malwarebytes thing doesn't pop up on my video. Um, I have no idea if it will or not. Hopefully not. Um, Yeah, Janet Yellen, the perfect resume with no ability uh, at all, at all. No ability if you wanted a good economy. Uh, but the only small ray of sunlight we got last week was the November jobs report was not as bad as the October jobs report, but that sets a really low bar. I mean, 12,000 jobs added, that's abysmal. And you can blame it on whatever you want. That's abysmal. When you start reading market reports and market analysts and all these other people, they all have excuses of why the government didn't do their job. It's always somebody else's fault. I think that'll change when Trump and company comes in. I think it'll all of a sudden be someone's fault, but it's nobody's fault right now. It's all this other extraneous BS that doesn't matter. But honestly, as if we look at the jobs report, the jobs report number, it's always it's always inaccurate. You take the non full-time hired people throughout the year at holidays, November, December, January, February, March, April, go back to school in August, like all these high temporary worker seasons, all of those get counted as jobs and they all get factored into the jobs report. So as low as October was at 12,000, with Thanksgiving and the preparation work for Christmas and New Year's and even Valentine's Day, Easter, and spring and all that stuff, the seasonal worker numbers went up. Even in a falsified jobs report, the number is not going to stay at 12,000. The economy itself, right? The full-time jobs report, as inaccurate as that is, that could stay at 12, but we're going to see more seasonal workers, so it's going to rise in general. Um, like I get the jobs report as an overall gauge, but it's such a falsified report. There's so much inconsistency wrapped into it. It just doesn't seem like a very great metric, very accurate metric. Um, but in the end, we're still left with the same questions for the week. Where does that leave us going forward? And what are the best investments? Like, what are the best buys for this market? And honestly, it's much the same. Bonds, which you could argue for bonds outright, or you could argue for bonds a slightly different way. And real estate, nobody's talking about real estate unless they're talking about the risk inside the commercial real estate market and the risk in multifamily market. And part of that centers on immigration and deportation, part of it. But we're still seeing that slump post COVID of there are a lot of companies who don't want to pay for a building when their workers can work from home or their employees can work from home. So that you still have a lot of people owning buildings, but they're not filled. The government has a ton of that. The government, it's like 70% of the government workforce is working from home, but we're still paying on office buildings. Makes no sense. So the commercial real estate market is in a slump. Uh, Multifamily is kind of in the same area. And honestly, everything's going to be in this kind of lull, like up and down a little bit until rates truly drop. I mean, rates right now are at like 6 point, just read the report, maybe 6.7. I mean, that's down, but that's not like we saw in Trump 1.0. Like the article I read yesterday was uh, when Trump was president, inflation was high, so rates went up. But in comparison, the average rate for his term in 2018 was 4.5%. That's a far cry from 6.5 to 7%. So it's not, I mean, you can compare, but it's not a great comparison. Uh, but at any rate, I'll continue to kind of talk in circles and get off, or just get off topic if I keep going. So let's look at the there we go. Let's look at the closed-end fund list for the week. So the entire system got an update over the weekend. I mean, the entire system, every single fund, um, gosh, everything. The stuff that I normally update, the cost, and then the net asset value, but I also went back through and updated the dividends, reviewed the targets. Everything got updated. We're slightly new list, slightly new starting list for pre-sorting. So here's what we're looking at. The stuff, kind of the general targets for right now. Bonds and loans, utilities and energy, if you energy transfer, if you can find it cheap, oil and tech. Tech's kind of at the I can't think of the word right now. That's unfortunate. That's the hard thing with live video. But tech tends to trend with oil. Like as oil goes up, tech will cost more because everything tech comes from oil. And then real estate. So we want to focus on monthly stuff. And then we want to hyper focus on yield unless there's a good reason to go with something else. It's not exactly what I wanted. Like this. This is close to an 8% yield, not 9, but it's close to an 8% yield, but it's still the most heavily discounted company. And I still think the fears are oversold. We'll find out for sure in about 3 or 4 days when we have they have a shareholder call scheduled. And whether I listen to the call or not, they'll produce the data soon after, and I'll get to dig into that. But it's the most heavily discounted company who's I mean I still think it's just oversold fears, and they're currently going through a buyback, so it should help prices in general. I think raising the dividend will help their price the most. But at any rate, it's going to stay on the list. And then we have utilities, but I honestly think we missed the utility boat, or at least this round, maybe this launch of the utility boat. We have a lot of just general stocks. TEEF is renewable energy, but most renewable energy is really non-renewable energy because it takes oil in order to be remade. There's a place for solar panels and hydroelectric and windmills. There's a place for that, but forcing everybody to do it makes no sense. And every one of those things requires oil in order to be made, and most of it requires oil in order to be installed. So, I mean, if you're going for a giant windmill on your property, you're going to need a diesel engine. If you want a hydroelectric pump at your dam, pending size, you probably need a diesel engine. And solar panels, I mean, unless you're just putting in that many solar panels, you can go to the store, buy one, and bring them back. The interesting thing long term about this, twofold. One, it's a term fund. So you would buy it today, and then it's set, and whenever it reaches the end of the term, they can actually decide to keep it going, or they can end the duration of the fund, and it would liquidate at whatever the current NAV was. So you get a decent dividend, and then the overall profit from the NAV. But the other part is with the tariff system, or with Trump's proposal to add tariffs to anything coming in from China, almost 80% of the solar panels are made in China. Uh, so I don't know how this is going to go. And with Trump's presidency pushing drill baby drill, people are still going to use this, but I don't think you're going to see as much of it as we do now. Let's see. There's technology, which I think is, I mean, I get it. The dollar cost averaging of things for us, if we bought this, it's about $2 higher than when we first bought it. So to buy another pack of it, it would cut our profits in half, but at the same time, you're going for overall extended growth. Uh, but if we're prioritizing this stuff, I want to look for deals. And currently, they're below that 9% threshold. And to be choosy, you have to be choosy unless there's a really good reason to not, or to make the exception. So that leaves us with these, all that hit above 9% except for this. This is utilities. I think we missed that boat. So that leaves bonds and stocks, which BRW is a shareholder activist bond fund where they're fighting for shareholder rights and increased dividends. They also own a lot of other things besides just bonds. They own a decent share of teeth, plus uh, plus minerals and gold and a lot of other things. Uh, HELB is the I don't know. It's a decent portfolio when it can. It's focused into areas that we want to be in. I'm not a huge consumer person, but it's focused in areas that we want to be in. So you get a little bit of everything. FCO is corporate bonds. However, or maybe they're also a huge private lender or like a business development company. And in the coming administration, the gentleman who's soon to be the new Treasury Secretary is an entrepreneurial guy. He's a small lending guy. And banks used to lend to small or say banks used to lend to small businesses or startup companies or entrepreneurship companies, but they don't do a lot of that anymore. Maybe like small loans, right? You can go get a personal loan from any bank. You can go get uh, essentially like 50 grand of loans for your business, pending your qualifications and your overall credit score. But in that gap between 50 and a lot, that's where these smaller business development companies, or in this case, a bigger company, but that's where business development companies come in. They're the ones issuing you your loan for your project. And FCO is a huge private lender. So it's yes, you're buying a bond company, and yes, you're buying a US company, and yes, you're buying a company that has a very high percentage of corporate bonds and fixed income, but you're also buying a company that's going to invest in a lot of other companies and who is well prepared to handle the incoming administration's policies. And then CIF is not the private lender end of things, but it is just a really small corporate bond company that has a really high percentage of fixed income. Then HFRO is real estate. So we're not buying tomorrow. I could make a case for all of these. It really comes down to you and what fits best with your portfolio. You get shareholder activism, portfolio in a can, which I get is kind of hard to see with blue to blue. So we'll do it this way. You get shareholder activism, portfolio in a can, corporate bonds plus uh, private lender, corporate bonds, and real estate. And all of the, I mean, outside of this one, I think all of these are higher than where we paid for them. So if we were buying, hmm, I can make a case for all of them, to be honest. It, gosh, if we were buying, I would pick either this one or say or this one, uh, just because I want to laser focus key in on our targets. Uh, straight straight corporate bonds, fixed income, well prepped for whatever the Fed's going to do, and well prepped for this incoming administration, and then real estate because I still think the fears are overblown. But I could argue for bonds and a lot of other stuff, and I love their shareholder activism. Uh, I can argue for a portfolio. There we go, in a can that targets the things that we want to look at. Consumer, no, but real estate, energy transfer, utilities, and tech. Those are all things we're interested in. I already talked about that one. Yep, and then super high fixed income. All of them make sense. It just depends on which ones make sense for your portfolio. So that's really all I have. It's much the same, although slightly different. So if you like the content, consider subscribing to my channel and then hit the like button because it really does push out videos. If you want to find me day to day, yes, you can drop comments on videos and I will respond. You can also find me on Instagram with the same adapted perspective handle. and I am posting about our entire 12-step system on Instagram. Uh, cover everything from general financial memes to day-to-day advice to scholarship information to overall financial strategy to closed-end funds and kind of anything in between throughout the 12 steps. Uh, so trying to think if there's anything else. And I'm drawing a blank, which is really not the best place to be and drawing a blank on a video, but such is life. Uh, Thank you to everybody who has subscribed to my channel. Please continue helping me spread the word and keep informing people about closed-end funds because I think I don't think I know, but there's so much more value associated with buying a closed-end fund, so much more access, so much better yield, lower overall risk, but then you really do get a lot more out of buying a single closed-end fund than say a single ETF or just a single bond or a single government treasury. Uh, like if we were looking at a closed-end fund that had Coca-Cola and Pepsi and all these other single stocks in it, compared with buying Coca-Cola in general, you're going to get a 9% yield on a monthly payer for right now about $8 to $9 a share versus buying Coca-Cola for whatever it is, 40 bucks a share, 35 bucks a share for a less than inflation dividend and a lot of risk associated with just the one type of company. So please help me spread the word on closed-end funds and share my content, share my channel, and yes, please just keep watching the videos. And uh, yeah, and then if you have feedback or want me to explain closed-end funds again, just please drop me a note on a video. Otherwise, have a great week. I will see y'all on another video. If I don't see you on Instagram first or on a comment first, just remember that as good as manifestation might make you feel, it's not going to solve your problems unless you do something about it. So if you really want to be a better investor, you got to put in the time and do some reading. The Investopedia has great info. My channel has previous info posted. Uh, it and even on my end of things, I still learn. I still read a bunch. So find free resources. Let's see, the Online Investor has a decent newsletter. Ready News does decent, maybe average to below average articles, but every now and then you find a diamond in the rough. And then who I primarily read is the Contrarian Outlook group. Their intro paid for membership service is $99 a year, and it's been that way the last 3 years. I don't know if they'll raise rates, but it's been the same thing the last 3 years. But whatever you're doing, continue reading, continue learning, continue to improve your own understanding of things, and then you automatically have more knowledge to work with. And then as you begin to invest and really, like, it's one thing to read it, it's quite another to do it. It's you have the knowledge, but then you end up with more confidence the longer you go. You can think about becoming a better investor, but until you actually do something about it, it's not going to matter. Is I guess really my point. And that's the whole thing with financial freedom in general. We can talk about money. We can talk about how to better manage our money. But until we actually do something about it, all that talking and thinking about it doesn't matter at all. So if you want to deep dive financial freedom, come find me on Instagram. If you want to talk about closed-end funds, comment on a video or find me on Instagram, right? And on your end of things, put in the work, read more, learn more, grow more as an investor so you can make better decisions for yourself. So whatever you have for the week, I hope it goes well. And otherwise, I will see y'all on another video. Have a great week. Bye-bye.